right. Good evening, everyone. My name is Brandon Mackey. I'm a writer at Small Cap Discoveries, along with Paul Andreola. And so Small Cap Discoveries is a paid newsletter. We're focused on uncovering Canada's best emerging growth companies, growth stocks. Myself, I'm a chemical engineer by background. I got into the investing world through a blog that I wrote called Motology a number of years ago. Through that, met Paul at LD Micro a few years ago, and we decided to collaborate on Small Cap Discoveries. And I've actually since moved into an operating business. I'm at a startup in Los Angeles called Soylent. We make food products, but I've stuck with Small Cap Discoveries and continue to write with Paul.
Yeah, I'm again, Paul Andreola. I'm the good-looking guy. He's the smart guy. I just want to make sure everyone understood that. So what we do is we really scour the Canadian market for up-and-coming small cap and micro-cap stocks, and we've got a system that's slightly different than I think a lot of other people out there. We look for fundamentally sound companies. We look for high growth. We look for a sort of certain set of categories, but ultimately we also look for something we call a discovery. And what we've found in our experience that you can have all the fundamentals there, and sometimes if the company's too well known or in some cases over known, you're not going to get the kind of lift that we're ultimately looking for. And we're not looking for 50% moves. We're looking for the 4 or 5 times moves, and we've been successful in using our criteria to find quite a few of those.
Okay, so as Paul alluded to, we're going to talk about multi-baggers today, which, as most of you know, is a stock that returns 100% or more. And so today we're talking about our process for finding them. So to find multi-baggers, most people start by asking questions about the business and only about the business. Our approach is a little different. They'll ask things like, how fast is it growing? What is the return on equity? What's the size of the market, addressable market? How good is management? Have they done this before? We think these are all really important questions, and we ask them, but they're not the only questions that we ask. And how we differ a little bit from traditional value investors is we also spend a good bit of time thinking about the stock. And really a term we use a lot is how discovered is the stock.
Precisely that. We'll go into a couple of details in terms of what we look for, but key is having a stock go from completely undiscovered to having it well-known, well-discovered, analyst coverage, institutional following, those sort of things. That ultimately is our exit strategy, is finding the stocks that get to that low.
So why did we do this? What we've observed over the years is that discovery drives microcap returns, and a lot of times it drives the returns more so than positive changes in the business. The simple recognition by the market of a company that had been left for dead, that is now a viable enterprise with revenues and growth, that one-time movement in share price can eclipse subsequent movements in terms of continued growth and positive developments. And so we like to be the beneficiary of that process, and it can drive returns really in a short time period to get to a multi-bagger. So discovery is the process by which the company's value is recognized, and that's what we spend all of our time studying. So this is an interesting quote. The discovery process is not a new concept, that we've uncovered over the last couple of years. Ben Graham, over 50 years ago, touched on it, and he was speaking at the Senate Committee on Banking and Currency, and he said, "That is one of the mysteries of this business, and it is a mystery to me as well as to everybody else. We know from experience that eventually the market catches up with value. It realizes it in one way or another." And his response was in the question to, well, how do you know when you buy a stock if it's going to go up or not? And his answer was essentially, it's a mystery, but I know from experience that it does. Well, what we've found is that in the microcap space, it's an ideal place to study the discovery process and this mystery because, a company like Google, all the information is out there. But with a microcap, it starts where information is very tightly held within the company, and then slowly over time, it becomes more widely distributed. And each part along the way, as positive news goes out, the share price goes up, and so you can start to learn how a share price, is affected by positive developments in the business. And our strategy is to understand this mystery and to profit from it. So the best way to see the discovery process in action is to really see it on the chart. The chart can tell you a lot about a stock and about a company as it goes over time. And so, at first we have the pre-discovery phase, and how does a company get to be undiscovered in the first place? Well, as Richard Branson of Virgin said, if you want to become a billionaire or a millionaire, you start out as a billionaire and start an airline. Well, if you want to become an undiscovered microcap, you start out as a well-known small cap or mid cap, and then you screw up or something happens, and the business goes through a downturn, and you get to a period where it's, the business may slowly be starting to perform, but no one's paying attention. And this is important because you get a lot of legacy shareholders that are stuck with the stock, and we'll see it later in a chart on Expel Technologies that this happened.
I think another thing that happens too is the dynamic, especially up in Canada. You get a lot of companies going public very early, pre-revenue, pre-earnings. What you tend to have is a lot of hype around the whole IPO process. And then as the fundamentals don't catch up with the promise, you get a company that actually the share price goes down while the business continues to build. Over time, as you get rid of the legacy shareholders that were there because of the promise, they either get tired, they sell because they're impatient, they don't see the sort of futures there, and you end up with this type of chart where it baselines for years and years as the business continues to improve. And then hopefully if it does finally meet what they're trying to accomplish, you start to see a discovery, and that's what we're again looking for.
So
I was going to say this is an example of a stock that we actually were early in on, and right at that discovery catalyst phase that's shown in the chart, that was one of our stocks that we picked at that time.
So in phase 2, which we term the catalyst phase, something happens to where our stock price begins to catch up with the fundamentals, and this could be another positive fundamental, like a positive earnings release. It could be a large contract. Sometimes it could just be a blog write-up or on a company that's already doing well that causes the public to really start to figure out the story and the value. And a key point of the catalyst phase is while the share price begins to increase and catch up with the fundamentals, it does so slowly because you have a lot of the overhang from existing investors who they may just be looking at, I had a stock at 10 cents and now it's at 20 cents. I just doubled my money. I don't care what it's truly worth. I better sell before something happens. And so you can get a lot of indiscriminate selling where sophisticated retail investors are really looking at the true value of the company, which may have gone up 5x, on one really good earnings release, that now it's cash flow positive and not at risk for going bankrupt. Into phase 3, which is the larger retail adoption phase, once early investors in the catalyst phase have invested, they're incentivized to, distribute the story out to their network. So you start to see Seeking Alpha articles, and you also have hopefully continued positive results in the business. And so you get a steeper slope of price realization into phase 4, which is institutional, where you have sophisticated hedge funds that may not have buying constraints that can buy these things early. They're now incentivized to go out into the mainstream media, and a stock, if it continues to perform, can become a must-own. And that's where you can really see dramatic increases in the price, such that we get to the last phase. In the post-discovery, where everybody knows about it, the stock often becomes priced for perfection. And a key point is it can continue to go higher. But if anything happens that's negative in the business, it's at risk. And this is where we don't like to be in terms of our investments. Yeah,
and we'll show it a little bit in more detail in the next chart. But all along the way, the stock, when we first found it, was trading around 8 times earnings. And ultimately, at the top of the cycle here, the stock was trading around 50 to 55 times earnings. And the business hadn't really changed. All the growth metrics were the same, but the price earnings expansion allowed for this sort of stuff to happen. And we really recognize that price earnings expansion based on this whole discovery process that we talked about.
Okay. And this chart is Biosign, if anyone is interested. And we're going to discuss this in more detail. So we talked about the 5 phases. The key point here is that we aim to buy stocks at the beginning of the catalyst initial buying phase. So we found that if you're too early in the pre-discovery phase, you can hold a stock for a long time even while the fundamentals continue to improve. But at this point, the margin of safety is maximized, in that people are beginning to understand the story, but there's a long way to go before the price catches up with the fundamentals.
Okay. So here's this is our recipe for, well, basically what we look for in any company that we recommend. We need to see the fundamental value that we ultimately believe will be part of what drives the discovery process. So we look for at least 2 consecutive quarters of revenue and earnings growth. So obviously the company has to be profitable at this point. So we don't while we follow a lot of companies that aren't profitable, really to make it through our screening, we have to see 2 consecutive quarters of earnings. And then the other thing, the whole discovery process, we really start to look at how well known is the company, how many blogs, how many times has it been written up, if any. Ideally, 0 write-ups, no Seeking Alpha articles, no analyst coverage, no. We'll ask who's sponsoring the company through brokers. All sorts of different things that we look for that you can readily find in social media or just by doing some simple Google searches. And then what we really like to do, and some of the CEOs that are here can probably attest to this, when we phone up the company, we love it when we phone up and say, hey, who handles your investor relations inquiries? When the CEO doesn't have an idea what that means, or the secretary doesn't know who to point us to, we know that nobody's talked to this company in months. So it really gets us excited when we see that, or in some cases, their website isn't very investor friendly. Those are all things that we know help determine that it's not a discovered situation. We also look for simple stories. I don't want to hear about some complicated widget that that takes forever to describe. We know that ultimately that simple story is going to have to translate well to as many people as possible. So the simpler, the better. At the end of the day, we just want to know the numbers are growing and you're able to sell and you're making money by doing it. And then management incentives. We want to see that management's aligned with shareholders. We love it when we see CEOs and management have written checks themselves to own a very large percentage of the company, because ultimately what's good for them is going to be good for the other shareholders.
Okay, so now we're going to go through a couple case studies, and these are actual companies that we've invested in, and a couple cases still invested in, and how this process works. So we'll start with Biosign, a company that many of you in the room, I'm sure, know and have invested in. This was a little before our time, but we're going to go back to the beginning. So on August 22nd, 2011, Biosign released their Q2 results. Revenues up 200%, did $114,000 net income, had $500,000 in cash, no debt, and a PE of 4. So anyone looking at that, a fundamental investor could look at that and see that as an attractive opportunity. And what we saw was, from a stock that had almost no volume, in that moment we had initial volume of about 210,000 shares in really 2 weeks after those earnings were released. But the PE only went up to 8 times. And so even after all that buying, if you were to look at that, this is again to show that a lot of times the legacy shareholders that are selling into that, they may not be looking to them. They just say, hey, I owned a stock here and now it's doubled. I'm fine with that. I thought it was worth nothing. Where the fundamental investors are saying, hey, there could still be a lot of room to run. And as we saw with Biosign, we'll break the chart out to today. There you see in the bottom left corner that initial buying phase. And then we saw really, once those sophisticated investors have invested, in this case, Mike King from the MicroCap Club, you may know, wrote it up at 55 cents. And that sparked, a larger increase in share price. And then each point along the way, you had positive earnings releases. The PE multiple expanded. Seeking Alpha articles start to get written as the retail adoption continues. And really, as the institutional wave caught on, as Paul mentioned before, the company got to a PE of about 50 at the peak. At this point, you had hedge fund managers on BNN recommending the stock. You had analyst coverage initiated.
One of the things I want to highlight, and I don't mean to insult any analysts here, but the first analyst coverage really came when the stock was already up around $6, $7. So it's the first time it was mentioned by any analyst in Canada. Prior to that, it had done all these great things. It had been moving like crazy. The numbers I think we had something like 20 quarters of consistent back-to-back earnings growth, and yet no analyst coverage whatsoever. Until finally around $6, $7, and then ultimately an analyst from Cantor Fitzgerald came out with his buy recommendation at $13.25, and it never saw above that price again. So what was the process? The company continued to, it's a great company. I don't want to discount it at all. The company's executing phenomenally well, but why? Why is the stock not performing when you have that kind of performance from the business? And we point towards that whole discovery process.
And then, as you can see, once a stock becomes priced for perfection, it becomes very difficult to maintain that. And you typically see, in any sort of negative news, price decline. But even though the company continues to perform.
Brendan,
yes.
If you superimpose institutional ownership over that, can you give any anecdotal commentary of what that statistic might have looked like from the phase 1 to 3 or whatever? Was it zero?
It's certainly probably close to zero.
The first analyst coverage, or first institutional ownership that we recognized came around the $6, $7 level. So right around here. That's the first we heard of. Now, there may have been others, but we didn't really recognize it until we saw it.
I'm not sure of the exact percentages, but yeah.
Rocket launching to the stock.
Absolutely.
Yeah.
Zero institutional ownership when we find a stock is what we like to see. Right? The less, the better.
Okay. The second case study, Spell Technologies, another one probably well known to a lot of people in this room. This one is interesting because how we showed Biosign, which went from pre-discovery through institutional to post-discovery. Expel was interesting in that it really never went through an institutional discovery process, but it became widely discovered by the retail investing community. So again, very, very similar. This one is interesting too because you can see that in 2007 the company was priced over $2, and it had a very compelling story, very compelling growth metrics. A lot of people got excited about it, and then really just a complete collapse into 2009, 2010, which is when management was changed, new CEO was brought on board, and good positive things started to happen, but no one was paying any attention because to them the share price was down from the $2 range to where no one really cared to even look at it. And here we can see a forum poster, Diddley Squats, who some of you may recognize as this man right here, posted about it at close to 25 cents after they had reported Q3 earnings in 2012, up almost 100%.
Yeah. So here's another example of a company that had, I think it was 8 quarters back-to-back of earnings and revenue growth, but yet we still flatlined. It's possible that I started the discovery process because the minute you start mentioning it, it has a viral tendency. So we did find it actually sub 20. The first time I mentioned it online was around 25 cents. And then the process just started again. We had more and more people that started to find out about the company. Never did we get analyst coverage on the stock, even though at one point it was the fastest growing company in Canada, best performing stock in Canada from the MicroCap space. But all along the way, we saw more and more discovery. And then ultimately what happened, we reached a peak price-earnings ratio of 35. And the company at that point was, priced for perfection. And then they did have a major hiccup. They missed the quarter. It was a little bit shy of what I think the market was expecting. And then to add on top of that, there was a lawsuit with 3M. So, you had the dangers of a company that's priced for perfection play out completely.
How did you find it at 20%?
So back to the process that we look for those at minimum 2 consecutive quarters of profitable earnings growth. We want to see at least 25% top line growth. And what we do is in Canada, we actually manually screen every single CDR filing. So we don't use any sort of software. We have to manually do it. This was an interesting situation because it wouldn't have shown up in most of the screening software. And those are the ones we want because the less it shows up in a screen, the more likely we've got something that's mispriced.
Yeah, in this case, it had kind of a strange listing, DAP-U, so it doesn't show up in a lot of systems. And so as you can see, this Q3 revenue is up 90%, PD of 3. That was in a filing, in that day that pulled up, and just not a lot of people were looking at it. It's very undiscovered, and so. a lot of people sometimes will look at that and say there must be something wrong with the company. How could it be trading so low? But
yeah, and another example, we phoned the company as soon as we could, and I don't think we managed to get a hold of management for 2 months. It was another sign that they're probably not exactly getting the word out, and the story wasn't sort of getting out there because management were too busy building the business.
Okay. So our third case study, this is another interesting one, Senkotech. We actually gave this same presentation in Toronto earlier in April, and this at the time was one of the companies that we presented that we felt was still early on in the discovery process, and one that we owned at the time and still do own in our portfolios. And so we walk through the checklist that we presented earlier and how it applies to Senkotech.
Sure. So this met all our criteria. Fundamental value was there. It was growing roughly 50% a year. It was trading at less than 10 times annualized latest quarter earnings. Thinly traded at the time. There was no reports whatsoever. There was a report in the MicroCap Club. I'm not sure how many of you guys are familiar with the MicroCap Club, but we had a posting there, so there was some coverage. Very few Stockhouse posts. I don't know if you guys are familiar with Stockhouse, but there's a various bunch of different online blogs and forums where you can talk about different companies. We couldn't find anything on the company there. Very poor IR. I phoned up the CEO, and I don't think I got a call back from him for about 3 months. As a matter of fact, when I finally talked to him, he was very skeptical. He would not give me any information at all. Again, I got excited about that. Most people probably get upset, but I got excited. And a simple story. They basically sell software that helps manage cash. And the CEO met the criteria. He owned 36% of the company, and we were pretty happy with that.
So this is what the chart looked like in April when we presented the company. It had reached the catalyst phase in a couple really good earnings releases where revenues were up around 30%, earnings doubled. The PDE was about 3.5. It had expanded to about 9 times, in the latest release, and there'd been one profile. So it was very early on in the catalyst phase. Stock price had increased significantly, but we felt there was more room to run. And since then, this one has continued to perform, and the discovery process has worked. Had a blowout Q3, revenues up 50%, earnings up 70%. The PDE multiple has expanded, now over 15. But from our experience, if the company continues to perform and the process continues to work, there's more room for expansion. So this is where the company is today, and we feel that it's just coming into the retail phase now. We're still completely unknown to the institutional community, but becoming more widely known, whether through write-ups, presentations, in the retail community as a growth stock.
So we actually initially found it when it was, you see, around the October spot there. We started buying the stock around 10, 11 cents. I mean, it's pretty small, thinly traded at the time, but as the company continued to perform, we've been adding to our positions.
Okay, so just to highlight a couple of the winners that we've had. Now, the process doesn't always work, and we've had some pretty bad losers as well, but more winners than losers, fortunately.
I'm going to correct them. We've had one loser, and I think we're down. The track record's actually posted on our site, so we'll be able to get a good example. But probably our worst performing stock is a company that was down 50%. But ultimately, when you use this process, the percentage returns and the amount of companies that are successful is significantly high. I can talk to some of these. So these are several of the companies that we've sort of found through the discovery process. Light Access was a company that we got engaged at 25 cents. Stock trades around $1.70 right now. Pioneering, actually, Kevin, the CEO, is here. We got involved there at 12.5 cents. Stock trades around 70 cents right now. You can see the return. Hamilton Thorne, Biosign, we showed the chart there. We had Covalon, Expel, and Cypher. That's just an example of how the system can work.
Okay, and we'll close now with a couple of our next discovery ideas that we feel are still pretty early on in the process, and 2 companies that we both currently own.
So, yeah, these meet the criteria that we look for. So, I'd argue that RenoWorks is a little bit of an anomaly. We've been following this company for a little while. They just had their first quarter of earnings and profitable earnings and revenue growth that met our criteria after a bit of a holiday. So that's one we think is extremely early in the phase. Gatekeeper, who's here as well, same sort of thing. They've now had back-to-back quarters. You can see the company, if you were to go back even further, you can see the company's more or less flatlined between about 10 and 30 cents. But it meets all our criteria. So we think these two are very good candidates for this process.
All right, thank you.
Any questions? Yes.
How does liquidity factor into your thought process or processes you would say?
So we're not afraid of liquidity or illiquidity. As a matter of fact, that's almost something we look for. Now it's a challenge because as we're starting to move more and more funds into these things, we have to find ways of getting liquidity. So a lot of times we'll speak directly with management or in some cases do some sort of financing or something to get liquidity. But we don't get turned off by a company if there's low liquidity. Yeah.
How do you translate that to the U.S. market? Most of these names are all in Spain. Really experts there. How do you translate that?
I would imagine the same dynamic happens in the U.S. if that's what you're saying. We specialize in the Canadian market, so we're we try not to dilute our attention.
Unless you're, Mike, from MicroCap Club, of course, you're right. It's very difficult. Like you would have to spend 8 hours a day filtering through all these companies. In Canada, a lot of times you can just filter based on the name. If it has resources or mining or ventures, we're not interested. So a lot of what we do can be done in 20 minutes a day. And you can find companies like this. In the U.S., I don't think that's the case. I've tried to do it, and been unable to really feel that we've had a mastery of that market compared to Canadian. Too big.
The gatekeeper you just mentioned, the revenue declining from fuel 12 down to fuel 14, from 5 to 3.7 million revenue.
Yeah.
Are you looking for some revenue?
If you take a look at the last several quarters, now we're starting to ramp up again.
Okay.
So you'll see we break down on a quarter by quarter basis. Now, if we have a year over year increase, that'll add to it. But ideally, we're looking at a more dynamic, shorter term change in the quarterly numbers. Yeah. So we're industry agnostic. However, we don't do anything resource-based or anything in the financial market. We're looking for businesses that have some repeatability, something that you can scale a lot easier. Resources you can really do that.
A lot of software, consumer products, cash flow positive biotechs type companies.
Yes.
So how do you know Mackey is not working out? When do you say I need to just play now?
You know what? Usually, while we give the company a little bit of leeway. If we see a quarter where we've lost that growth rate, if it starts to decline, and there's some seasonality to some business, so you've got to be very careful. But ideally, if you see a quarter that's down from the year-ago quarter, we start to get very nervous. If we see two, that's when we start getting our parachute on and jumping out of the plane.
And how about build a solution? How much money is allocated on an idea?
That's the toughest part. It really is a function of how liquid the stock is. How we tend to try to find 5 or 6 good ideas, and if something's not a lot better than one of those 5 or 6, we'll allocate a small amount of money. If we feel it's a lot better than any of the 5 or 6, then we start allocating a lot more money. It's a bit of an art rather than a science.
Do you allocate an entire portfolio to 5 or 6 ideas?
We do. We try. We sort of use the hockey team analogy. You try to get your 5 best guys on the ice. If you got another player that looks like he's going to be better than one of those 5, you're going to switch him. Yeah. So that's the other thing is we're not. A lot of investors are binary. They'll look at a deal and they'll say, okay, is this good or bad? Should I invest or not? We ask, is it better than anything we own? And that's what drives a lot of our decisions. Yeah.
Mm-hmm.
And that's fine.
Yeah.
Great. Thank you.
All right. Thank you.